Hello, I'm Ed Parrott. Welcome to my weekly real estate market report. This week we're going to take a look at the Federal Reserve meeting from last week, the economy in general, the housing market in particular, mortgage rates, and what the outlook is for the future. On the FOMC meeting this past week, their decision was to hold rates steady for the second meeting in a row. So they stand at 5.25% to 5.5% for the target rate. The current effective rate is 5.33%. Now this is the second pause in a row, and a number of people are seeing this as dovish on the part of the Fed. I'm not so sure that I would go that far. They're still very concerned with policy, although they don't appear to be as aggressive as they were with their monetary policy. I would not go so far as describe it as being dovish. I would like to discuss some of the points that Chairman Powell made in his opening remarks, and also I'd like to address a couple of questions that he answered for the reporters. In the opening remarks, Powell said that the Fed is committed to their dual mandates of controlling inflation and maximizing employment. He emphasized that the FOMC, Federal Open Markets Committee, is strongly committed to their goal of 2.0% core inflation. They are attempting to achieve this by tight monetary policy, specifically a high federal funds target rate, and also they are reducing the Fed's securities holdings. These two factors taken together put pressure on interest rates that mortgages and other loans are charged. Now, since March of 2022, the Fed has increased the target rate by an amount of 5.25%. This has been spread over 11 increases during that time period. So it is a welcome relief that this is the second meeting in a row that they've held the rate steady, but we'll have to wait and see what happens in the future. The chairman did indicate that the Fed does intend to continue to reduce its securities holdings. So while they're not increasing rates at this time, this will still continue to keep some pressure on monetary policy. Powell also mentioned that the GDP grew at 4.9% in the third quarter, and to use his word, an outsized 4.9%. And I will grant you that is a good rate of growth. This rate of growth was the result primarily of consumer spending. And going into the fourth quarter, I would expect consumer spending to remain strong. We may or may not get 4.9% again, but I do expect we'll see a good rate of growth again in the fourth quarter. Moving into next year, things may slow down a little, but we've got a good growth going right now, so that gives me hope that we are not looking at a recession anytime soon. Yeah, Chairman mentioned that the housing market is flat, and he attributes that to the mortgage rates. Also, he brought up the fact that the labor market is tight, although it is becoming more in balance in his words. He does mention that the demand for workers far exceeds the available supply of workers. Also, as I mentioned in last week's report, he did bring up the fact that the labor participation rate has increased in the last several months. And when he got onto the topic of inflation, he did mention that there have been improvements. Inflation a couple of years ago was around 8%. I don't remember the exact figure, but it's down to 4% now for the core inflation, 4.1 to be precise. That is definitely improvement, and we've seen other improving indicators in the past 2 or 3 months. But the chairman did also indicate that 2 or 3 months of good news is not enough to get overly excited about. In essence, although he did not use these words, they're basically saying that the Fed is taking a wait-and-see attitude. Specifically, he was asked, are we expecting another rate increase next month? And his answer was their decision was for this month only. They'll take a look at next month. Another question was asked, could we have 3 or 4 meetings where there's no rate increase and then have another rate increase? He said basically, sure. But he did say that yes, we could have several more meetings where there was no rate increase. Then, if conditions warrant, there would be further rate increases. So as I said, in my words, they're taking a wait-and-see attitude. But that's certainly better than the more aggressive stance, in my opinion, that they've had up till this point. He was also asked specifically about the Fed's thoughts on a recession in the near term. He answered that specifically saying that although the tight monetary policy is putting downward pressure on the economy, the committee does not see a recession in the near term. So all in all, I was happy to hear the news out of his press conference. He didn't sound quite as aggressive as he has in the past, although I certainly wouldn't call it dovish either. And although I do consider Mr. Powell to be way too aggressive on his monetary policy, one thing I will say for him is when answering the reporters' questions, he does go into detail and actually answer the reporters' questions. So he's not acting like a politician, and I have to give him props for that. Moving on to the economy, as I mentioned, the GDP growth for the third quarter was 4.9%, primarily on consumer spending. Job growth is still strong, although it is cooling off a little bit. The payroll processing company, ADP, reports 113,000 new jobs in the private sector for September. Now, this is down a little bit. For 2023, the three-month rolling average has been just over 200,000 new jobs. But 113,000 is not a bad number by any stretch of the imagination. And also bear in mind that there are still more job openings than there are people to fill them. So I don't expect the job market to really deteriorate anytime soon. Now, annual wage growth is also slowing a little bit. For people staying in the same job, the annual growth is 5.7%, and people taking a new job elsewhere is at 8.4%. A year ago, these same numbers were 7.7% for people staying in the same job and 15.4% for people moving on to a new job. Now, on inflation for the U.S., the headline inflation is 3.7%, as I mentioned. Digging a little deeper, we'll see that the food inflation is also 3.7%. Of interest is energy inflation is actually negative 0.5%. But the core inflation, of course, takes out the food and energy components, and that is the number that the Fed is working on getting down to 2%. And that core inflation for September was 4.1%. Now, the next inflation report will be out on November the 14th, so we'll take a look at that in a couple of weeks and see how things are going. Now, one area of minor concern is Europe. The Eurozone GDP actually fell by 0.1% last month. Of the countries in that zone, Austria, Germany, and Ireland all had a contraction last month. Only France managed to pull out a small gain in their GDP for the month. And of course, this is of concern because we don't want to see a contraction anywhere because things have a way of spreading. For the Eurozone, their inflation numbers are about the same as ours. They got 2.6% headline inflation and 4.5% core inflation, so they're a little higher there, but in the same ballpark. However, getting back to this country, also of note is the bond market reaction to the second pause in interest rates. They liked it. The bond market had a little rally after that, and that of course pushed the yield down. That will be a good thing for interest rates all the way around, as we'll see in a minute when we get to the mortgage rate discussion. So that's a good thing, as Martha would say. Moving on to the real estate market, we have some good news for sellers. Case-Shiller has published their index of home prices, and it has increased 7 times in a row now. So it's up 0.9% in August. Back in July, it was up 0.7%, and year to date, it's up 4%. Now, it's also 1.5% above the previous peak in mid-2022 before we had our little bit of a dip. Now, the Federal Housing Finance Authority has an index as well, and theirs is up for the 12th time in a row. It was up 0.6% month over month in August. Back in July, it was up 0.8%, and it's up 6% for the year to date. Now, when we compare this one to the 2022 peak, it's up 4.7%. So why the difference between the two indexes? Both Case-Shiller and the FHFA use transaction pairs. That is, they look at the same house that sells in two separate transactions. So if a house sells in, say, 2019 and then sells again in 2023, they compare the prices between those two sales, and that's how they calculate their indexes. The difference is with FHFA, they look only at sales that involve conventional mortgages. So they do not consider any cash sales, and also they do not consider any jumbo loans. That's your difference. From that standpoint, I think that the Case-Shiller index is the better, more accurate index overall. But here we're talking national numbers, and of course real estate is based on local markets. So let's take a look and see what's happening in the 20 largest cities around the country. Now, in 10 of those 20 largest cities, we've set new record highs for the price index. Of particular interest are Chicago and New York, both of which are up 5% over the 2022 peak. And that's followed closely behind by Cleveland at 4.9% above the 2022 peak. Now, in a couple of my previous reports, I have made note of San Diego and their extraordinary rate of growth, and currently they're 7.5% increase for the year to date. And previously I had not dug into the reason for this, although I mentioned that I should, and I have. And it turns out that they're just an extreme example of the nationwide problem of supply and demand. There is a large demand for the San Diego area, and the number of homes for sale is even lower in that area in terms of existing homes. So the exaggerated shortage of available inventory is the reason for the increased price. Bearing in mind, California is already at the top end of the market in terms of median price. So frankly, I don't know how people afford it. They must be making a whole lot more money than I am, I'll tell you that. Another area of interest in the real estate market is new home construction. As I have mentioned in previous reports, the market is shifting toward new home construction just simply because there are not a large number of existing homes for sale right now. So this is a boom for the home builders, although with this interest rate and the prices, even the home builders are having to offer concessions for sales. But still, they're doing okay right now as far as I can see. But my point I wanted to make here is the fact that the construction industry is becoming more concentrated. The biggest builders are getting bigger and they're going public, so they're trading on the stock exchanges. Of the 10 largest builders in 1989, they accounted for approximately 9% of the new home construction sales. By 2000, that had doubled to 18.7%, and by 2022, it had more than doubled again to reach 43.2%. Now, if we look at the top 20 home builders, they account for 53% of all the new homes sold. And as I say, it is becoming more concentrated, and of the top 20, 17 are currently publicly traded. Now this means that the board of directors and the CEO have to be concerned with share price or dividends or stock buybacks or some combination of the three to make the shareholders happy. I'm not saying this is good or bad, it's just the fact that publicly traded companies behave differently than privately owned companies. Now, of course, sometimes the board of directors and or the CEO can make bad decisions and have a catastrophic result. A famous example of that is what at the time was Apple Computer, now it's just Apple, when their board and chairman made some bad decisions and came very close to going bankrupt, and they brought Steve Jobs back in and he turned it around, and the rest, as they say, is history. So that's my only point with the publicly traded companies. That brings me to mortgage rates. Now, we had some good news for the sellers just a little bit ago. Now we've got some good news for the buyers. As we said, this is the second meeting in a row that the Fed has not increased their target rate. And there is some hope that we have seen the last of the target rate increases. It may remain at the 5.25 to 5.5% that it's at now for some time. I can kind of live with that, but I'd like to see it start coming down next year slowly. I don't want to see them drop it like a rock, the same way they raised it like a rocket going on the upside. We don't want to see the same thing going down. What happens when the Fed does stop? Historically, over the last 11 cycles, 6 months after the last rate increase, mortgage rates have decreased an average of 0.6%. And I will point out that since the Fed's announcement on Wednesday that they were not raising rates again, the average 30-year mortgage rate has dropped 0.5% already. So it's currently standing at 7.51%, down from 8.03%. A year ago, it was 7.2%, and of course, the recent low was 5.99% back in February. Have we seen the last rate increase? Maybe. We can hope. The next meeting of the FOMC is on December 13th. The market is placing a 15% probability of another 25 basis point increase during that meeting. But if you look at it the other way, that's an 85% probability the market is placing on another pause. Let's hope for the 85% instead of the 15. While the wild ride may be easing and the bucking bronco isn't quite as wild as he was, I think the horse is still running pretty fast. So we can just hope for things to remain steady here for a little while, and maybe that horse will get tired after a while and we can just go on a nice leisurely ride instead of trying to hang on for dear life. So thanks for watching. I hope you got some good information out of the report. If you did, then please like and subscribe. I look forward to seeing you next time. And as Sebastian says, thanks for watching and have a good night.